Good afternoon, ladies and gentlemen, and welcome to the BMO Private Equity Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish response where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Hamish Mayer, Fund Manager, and Christine Cantrell, Director Head of Investment Trusts. Good afternoon.
Good afternoon, everybody. I'm Hamish Mayer, Manager of BMO Private Equity Trust. Welcome to this Investor Meet Company presentation. Over the next 30 minutes or so, I will give you an introduction to our investment trust and give you an update on the recent performance and portfolio developments. And there should be ample time for any questions you may have after that. BMO Private Equity Trust was established in 1999, and in the 2 months' time, we will celebrate our 23rd anniversary. I've been managing it since the beginning. I've been an investment manager for all my working life, which is well over 30 years now, starting with Robert Fleming and Company down in London back in the late 1980s. I lead a team of 10 investment executives based mainly in Edinburgh, though we have one director in Toronto. And all of them contribute to the management of this, our flagship private equity investment trust. We also manage 9 other funds or programs, giving us a total assets under management of around £1.5 billion. BMO Private Equity Trust is a good vehicle to give you exposure to the private equity asset class in general. Private equity allows investors to gain exposure to growing companies, to new technologies, to businesses which are simply inaccessible to those investing through the public markets. And so an investment in BMO Private Equity Trust will give you that exposure, which you will find it very difficult to gain elsewhere. This company is a private equity fund of funds with a large co-investment component. About 60% of the portfolio is invested into private equity funds, invested, raised, and organized in the UK, in Europe, and some in North America. The remaining balance of the portfolio, about 40%, is invested directly into private companies, so-called co-investments, with each of these deals led by an experienced private equity firm. We have about 35 companies in the portfolio and a very well-diversified portfolio covering many different geographies and sectors. Private equity is a naturally risky asset class, and diversification is the only realistic way of reducing what is a naturally high risk down to more moderate levels. And the combination of the funds component plus the co-investments in our portfolio allow us to deliver strong private equity returns at only moderate levels of risk. We favor investing in buyouts, the most successful part of the private equity market. We like the mid-market. So these are companies with a value of below £500 million, and many of the companies below 100 million. We like to invest with emerging managers. So these are up and coming management groups, because we believe that at that stage in their development, the alignment of interest between us as investors and they as managers is very close, and that in due course leads to very strong long-term returns. We also have a distinctive dividend policy. We pay out 4% of NAV per annum as dividend. It's paid out in 4 quarterly installments, where the quarterly dividend is 1% of the average of the last 4 quarters NAV. So that is a predictable dividend. If the calculation leads to a number which is below the last dividend paid, we maintain the last dividend. So at any given point in time, you're only missing one piece of information, which is the latest NAV. So that allows our investors to benefit from the realizations that we have coming through and to be able to rely on a dividend of a specified amount. Our track record over the last 23 years is strong. It compares well with all our private equity peers in the investment trust sector, and delivers a performance, or has delivered a performance, which is well ahead of investment trusts that invest in the listed markets area. So I'm now going to take you through a slideshow which covers our recent results and key portfolio developments. There are a number of slides here. Some of them are quite detailed. I will summarize them, and this should give you a good idea of the characteristics and strengths of this company. So this first slide just shows you the progress that we've made during 2021. Our third quarter numbers for the 9 months to the end of September came out just at the end of November, about 6 weeks ago. The third quarter NAV growth was 7.2%, which has led to a year-to-date return of 23.8%. To put this in context, last year, 2020 was a very strong year for us. We were at 22.7% for that year. So we've exceeded the return for 2020 in the first 9 months of 2021. We have a dividend that's being paid at the end of this month, 5.27 pence, to those on the register on the 7th of January. The co-investment element stands at 41%. The upper limit under our investment guidelines is 50%, so there's a bit of scope to increase that should we wish to. Earlier in the year, we increased our revolving credit facility from 75 million to 95 million pounds, and that added to our 25 million euro term loan gives us borrowing capacity of roughly 115 million pounds. Currently, we're only using about 12 million pounds of that, so there's plenty of scope to make new investments funded by borrowing if we need to. The next slide here just shows you the new investments that we've made during the third quarter of 2021. I'll very quickly talk about these. These are fairly representative of the type of investments that go into the portfolio. So we have backed 4 new private equity funds. FPE, which is a growth equity fund, where we've backed them before. SEP, Scottish Equity Partners, it's also a growth equity and venture capital fund. We've backed SEP since the late 1990s. So this is the 6th fund in a series that we've been involved in and benefited from. Inflection Buyout Fund 6. Inflection is one of the leading buyout firms in the UK and indeed in Europe, and we've been backing them for nearly 20 years as well, a very significant relationship and a successful one for us. And lastly, Archimed 3. Archimed is a France-based healthcare specialist whom we've also backed before and also co-invested with them. We made 4 new co-investments during the quarter. I'm going to talk about these individually in a minute, but you can see that these are in a wide range of different sectors with different lead managers and in different geographies. And lastly, we made a small investment in a secondary. So this is buying a fund that already existed with the Swiss-based manager CapViz. This next chart here shows you the long-term progress of the NAV and the cumulative dividends. The grey section above the blue section is the dividends accumulating. You can see there is a very good upward trend with a slight intermission during the global financial crisis of more than a decade ago. This next slide is another way of looking at our performance over an even longer term basis. This takes us right back to the start in March 1999. And a couple of things to observe here. The dotted line at the bottom is the all share index total return. And you can see that both our share price total return and NAV total return have significantly exceeded that, far exceeded that. And this chart shows you the benefits of being invested in private equity and staying invested in private equity, where the premium returns that you receive every year or most years compound themselves very powerfully, so that we have a situation where, compared with investing in the stock market, you make more than double the annualized return and about triple the capital gain. This is another way of looking at performance. It shows you the annualized rates of return over recent years, which have been strong. The next slide here shows you the new investments that we've made in 2021 to date. You can see there are quite a lot of entries here. I'm not going to talk through every single one of them, but this contrasts quite sharply with 2020, where we made a few investments early in the year, and then we had a very quiet period throughout the rest of the year, for the simple reason that the world was suffering from a global COVID-19 pandemic, which was highly disruptive. But things have, from the tail end of last year onwards, picked up very significantly. The private equity firms and their underlying companies have adapted very well to the new circumstances. They've proved themselves to be highly resilient. And so we've been able to make a whole series of new investments throughout the course of 2021. You can see that, again, these are very well diversified by manager, by type of fund, by geography, and that underpins the diversification that I was talking about earlier. So I'm now going to talk about some of the new investments, our co-investments here specifically. So the first one here is Habitus. So Habitus is a social care company that looks after disabled adults in a range of residential facilities in Denmark. This deal is led by Apposite. Now, Apposite are healthcare specialists, and they have a lot of experience in this area. Indeed, they already have a deal in Swanton, in which we're also a co-investor, which does a similar activity in the UK. The people that you back running a company like this not only have to be good businessmen, but they have to have very high ethical standards, because it's a very sensitive area. And in this company, not only do we have the benefit of Swanton's expertise, some of the people that have been involved in Swanton and in a previous company, Lifeways, that we have invested in, are actually involved in this company. So we can have complete confidence that the people that we are backing know what they're doing and will do it well. We're hoping to make over 3 times our money in this investment over the next 4 years. The next investment here is completely different. This is Contained Air Solutions. This is a business based in Manchester. It designs and manufactures microbiological safety cabinets, in other words, fume cabinets, which are sold to academic institutions, to chemical and pharmaceutical companies, anybody who's handling hazardous material. And this company has had a lot of growth over recent years. It had quite a strong period during the COVID pandemic for obvious reasons. There's a lot more lab work going on. And we've been able to get into this business at really quite a low price. We think they've got excellent prospects as they internationalize the business, firstly into the United States and then to other places. And again, we're hoping to make more than 3 times our money. This deal is led by Accord, which is a new small private equity firm that we've been tracking for a while, and we've backed them in this first deal. This next investment is JT IoT. This is a provider of infrastructure for the Internet of Things sector. So essentially, there are lots of other things apart from mobile phones that have SIMs in them. And this company provides the software and the technology for those devices to speak to each other. So vending machines, cameras, that sort of thing, all need a network. This was a business that spun out of Jersey Telecom, the state-owned telecoms company. And the deal is led by Perwin, who are a London-based private family office-owned private equity firm that we've got to know over the years. This is a fast-growing sector. We expect to do well out of this deal, hopefully make over 4 times our money. The next deal is Plenum. Plenum is a company based in Canada. What do they do? Well, they basically provide hyaluronic acid for aesthetic purposes. So essentially that is injecting often into people's faces to improve their appearance, not just out of vanity. Sometimes it's for people who really do need that because of disfigurement, etc. And it's a better solution than using the likes of Botox. This is a growth area, not just for reasons of cosmetics, but the ability to improve people's appearance has improved with this technology. There's a lot of growth here, and this deal is led by Archimed, who are healthcare specialists based in France, who found this deal. And again, we're hoping to make about 3 times our money. The next company here is completely different. Again, this is Omelette. So as the name might suggest, this company makes essentially chicken coops. So that green thing in the picture on the bottom left is the chicken coop. So this business was established by 4 entrepreneurs as they left design college about 15 years ago, and they've built up really quite a substantial business with these cleverly designed chicken coops. They've already got a significant presence in the European and American market, but there's a lot more to go for. Keeping chickens in your garden and hence being able to produce your own eggs and control your own food is very much a growing trend. It's in tune with various cultural traits. And so we think there's a lot to go for. And Piper Private Equity, who specialize in consumer brands, are the lead here. The next one is one that we made just after the quarter end. Virtue Capital, the Canadian VCs, have put us into this company called Path Factory. So Path Factory is a software company that provides software which is used by industrial businesses who are buying various different components. It's essentially a means of directing their internet searches towards the quite technical products that they're looking for. And so their technology, which is a kind of marketing or advertising technology, facilitates the buying journey for an industrial buyer. So it's a bit like when you or I might be on Facebook and we get shown websites of things that we would be interested in. This does the same kind of thing except for industrial buyers. So again, this is a new market, but it's growing very rapidly. And Virtue Capital, as I said, one of the leading venture capitalists in Canada, have found this business, and we'd expect to make a good return off this one. So those are the co-investments we've made. The next slide just covers the realizations that we've had in 2021. Most of them have been at very acceptable multiples of cost. You can see down the right-hand side. I'm going to talk about 1 or 2 of the larger ones here. Firstly, Dotmatics, which we had back in April. Dotmatics was a software company. It provides software for universities and pharmaceutical companies. It basically allows them to model different molecules, but importantly to share their research on an ongoing basis amongst different collaborators, securely. And this was a deal led by Scottish Equity Partners, but the company was sold after 3 years to Insightful Science, which was a US-based scientific company. It very much hit the right part of the market at the right time. It was sold, after the first phase of the pandemic. I think people were appreciating that the combination of life sciences with technology was a powerful one. And there are people with deep pockets in America that want to invest in this area. So us and SEP were very much the beneficiaries of that. We made nearly 9 times our money over 3 years, and we still retain 12% of our investment going forward. So we should make even more ultimately. The next largest one here is Hughes Gray. This is a builder's merchant chain based in Wales and the northwest of England. The deal was led by Inflection. The thesis was really that this business should expand from its northwestern regional base across other parts of England and to become a national or semi-national chain, which is what they have done over the last 3 years. And that was sold out earlier this year for really quite a good price. This was even more impressive, bearing in mind that early in the pandemic, the entire company was shut down for nearly 2 months, but it rebounded back very strongly. The customer base for this business tends to be small jobbing builders who basically build extensions and that kind of thing. And there's been a lot of demand there through the pandemic. So an excellent result there. The third one is Pet Network. So this is a large format pet shop chain, a bit like Pets at Home, except they are based in Croatia and the surrounding countries in Southeast Europe. The deal here is led by the Rohatyn Group. So they have a significant private equity capability in Southeast Europe. And after 3 years, this business has expanded very significantly, professionalized a lot, and that was sold on, and we made over 4 times our money, an excellent return. It's worth mentioning the next one down, Stax, was a partial realization. Stax is still one of our largest holdings. It is a beneficiary, a very clear beneficiary of the pandemic. It provides clean room consumables as its main business, but it also makes rubber gloves and masks. And clearly, these things have been in huge demand, and so it's been trading well ahead of the original plan, and that's allowed the lead manager, Silverfleet, to return quite a lot of money back to us already, and we're hopeful that the full investment will be realized probably next year and will make an excellent return. All the other exits further down this table again illustrate the diverse nature of the portfolio. There are lots of different countries represented here. The deals have been led by a wide range of different managers, and they're completely different businesses. But the common factor is that we've actually, in just about every case, delivered a really good return. And that continues on over onto the next page. I can leave you to look at this at your leisure. We have made these new commitments to funds and to co-investments over the year, and then the investments have been drawn down as the commitments have been made, and this shows you quite a lot of the more significant underlying new investments. So you can see again quite a wide range of different types of company, everything from clothing companies through to microscopy companies, regulatory and compliance businesses, software companies. So it's a very broad spread, and that is deliberate policy to achieve that, and it's a good thing that we can continue to maintain that level of diversification. Next page here just shows the longer term pattern of money in and out to the portfolio. So there's clearly a relationship between active periods. If it's active on one side in terms of realizations, it's tend to be quite active with redeployment of money also, and the converse is also true. Realizations in the year to date are running at over 120 million, which is more than we've ever had in a full year before, and it's likely that for 2021 as a whole will end up with something like 140 million of realizations, which is about 40 or 50% up on what one would normally expect, and that is a function of there having been a much more limited number of realizations last year. We were down at sort of a quarter of that level, and a certain element of catch up taking place during 2021. I think it's now worth spending a few minutes talking about the largest underlying holdings, because these are the ones that are still in the portfolio, and developments amongst this bit of the portfolio will be quite influential to NAV growth over the course of the coming year. So the first company here is Weirdfish. You may have come across this as a clothing company. You may have a Weirdfish sweatshirt or jumper. Weirdfish have really done very well through the pandemic. To start with, I was quite concerned about how they would cope because all their shops were shut at one point. But they made a very successful large-scale transition towards e-commerce, And then when their shops were able to open again, they did benefit substantially from the trend towards staycation. So this one is going really well. We're hopeful we might be able to realize this later this year. The next one here is Sigma. This makes electrical components for quite a wide range of consumer goods. They have factories in America, Mexico, and India. It's a US-based business led by Argand Capital. This is going pretty well, and we think this could also be realized during 2022. I've mentioned about Stax already. So again, we're hoping for a good, strong exit later this year. The next three are all led by Buckthorn, who are energy specialists. Ashtead is an oil services company that rents out equipment that is used for monitoring subsea installations. So it's not just oil, actually, they've got a big business in renewable energies. And this was listed on the AIM market at the end of November, and we're getting a significant chunk of our money back from that exit, but there's still plenty of upside to go for. Trax is the next one. This is also in oil services. It basically has a technology that's used for plugging oil wells when they're not needed anymore and decommissioning them. So there's an element of counter-cyclicality here, where as the various offshore oil provinces decommission their hundreds and hundreds of oil wells over the next few decades, there will be a steady stream of business for this company. TWMA is again involved in that sector, but what it does is it basically cleans up drill cuttings. So when you're drilling for oil, the cuttings come up, they're contaminated with oil. They have a system which sits on the oil rig which cleans up those cuttings. It breaks them down into pure water, pure oil, and a sort of clean, dusty solid, which can then be put back into the sea with no pollution caused. The important thing about it is it does also improve the efficiency of the oil rig and reduce their costs. Next one down is Ambio Pharmaceutical. This is a producer of generic drugs, mainly peptide-based drugs. These are quite difficult to make. They're used mainly for gastrointestinal conditions. This is actually a remnant of our original investment. We've sold 3/4 of it already. The final bit will probably be realized when they achieve a listing on the Hong Kong Stock Exchange, which is planned for this year. Next business, number 8, is Siro. This is an Italian funeral homes chain based in the north of Italy. The deal is led by Augens, who are an Italian private equity group that we've worked closely with. So unlike in the UK, in the US, and in France, Italy doesn't have chains of funeral parlors. So this is a new thing for Italy, and this is the largest such chain in the country, and it's building through acquiring other funeral parlors, and they've also acquired a couple of crematoria, giving a bit of vertical integration. This company has done well. It did a lot of business actually early in the pandemic. As you probably remember, it started in Europe and northern Italy. But they've also, their sort of stature within the industry has gone up because they were able to help a lot of their smaller competitors cope in a pretty difficult situation. So that is well on track. The next one is Accuvene. So Accuvene is has a technology which allows clinicians to basically do injections more efficiently, because it essentially highlights where your veins or arteries are. It's an infrared-based system which you sort of shine on your arm or your leg or wherever, and it picks up on the hemoglobin in the blood, and it is finding a good take up initially in America, and then it will spread into Europe. It's really quite an interesting novel device, which does save time, but it also saves people's lives. And then lastly, we've got Avalon. This is a funeral plans provider, so not a funeral parlor company, but they sell funeral plans in advance of need. This is done well. It's led by Lonsdale Capital. Having said that, this bit of the sector is under a bit of a review at the moment by the government, and the effect of that essentially means that it will be difficult to sell this business for another year or two. So we'll have to wait a little while before we can realize that. So next slide here just shows you the geographical spread of the company. Half of the portfolio is in the UK. That is our home market, obviously, but it's also the deepest and broadest private equity in Europe by some margin. Most of the rest of the portfolio is invested in continental Europe across all the different markets. There is an active private equity market in just about every European country. We also have about 13% in the US. So we've had that for many years. We have a number of strong contacts there, so we believe it's sensible to maintain that exposure whilst those relationships continue to deliver strong returns for us. The right-hand slide here shows the breakdown of the portfolio by age or by vintage year. And the key thing to bear in mind here is that most private equity deals are organized around a 4 or 5 year hold, actually. And so after about 3 years, if the company has followed its investment plan successfully, then the lead managers will be planning an exit. So we think that monitoring the 3 years and above component is a good proxy for the mature element of your portfolio, or the maturing element, and it's from that element that realizations are very likely to come. And so essentially we've got plenty of scope to maintain our flow of realizations into the foreseeable future. The portfolio is not highly valued. It's about 9.9 times on an enterprise value to cash flow basis, which is low compared to our peers, and it's low compared to the stock market. And we don't have very much underlying debt in the companies. It's basically about 2.6 times on a debt to cash flow basis, which is again low by the standards of our peers. And so, we're not taking excessive financial risk here. This next slide just shows the portfolio by industrial sector. There's quite a lot of information on the slide, but the point to make is that there are three quite large sectors: industrials, which covers quite a wide range of things, but there's healthcare, and then there's information technology. So we have, between these two sectors, about 40% of the portfolio invested there. And during the pandemic and afterwards, there's been a lot of appetite for investment in information technology, hardware and software, with the digitalization of the economy having been accelerated through the pandemic. We were already well positioned in these sectors. And again, healthcare has been a good recipient of new money. I think people are appreciating the importance of healthcare. If you don't have successful healthcare, everything else can grind to a halt, as we've just seen. And so a lot of the incoming interest for buying companies in our portfolio is coming into these sectors, and we're well placed. And this is part of the reason that we've had such a strong flow of realizations this year. Just to summarize, I think, as you will have picked up from what I've said, the portfolio has performed well through the crisis. It's fair to say that almost all the companies in the portfolio were presented with challenges. Most of them rose well to those challenges and proved themselves to be highly resilient. Partly that was a function of the great spread that we had in terms of industrial sector exposure and geographic exposure, but also that the private equity lead managers were able to intervene to help their companies, to find best practice and how to cope with a very challenging situation, to improve their negotiations with banks, to access government support schemes. All those kind of things really have underlined the strengths of the private equity investment model, where the investors don't just sit back passively watching what's happening, but they can actually help the management of the companies to cope with the situation. And that's not just in terms of providing capital, which they occasionally have had to do, but actually providing, really deep expertise. And so I think that this whole period has underlined the strengths of the private equity investment model, and it's one of the reasons that many people are looking to increase their exposure to private equity over the long term. We've got plenty of scope to make new investments. Obviously, we've had a lot of money come in through our realizations, but also we've got very substantial unused borrowing facilities. There's plenty of deal flow for us. We're making fresh commitments to funds and co-investments, essentially converting a small proportion of our deal flow into investments. We think that the exit markets, which are currently strong, appear to have good momentum going into this new year. And we think that all of these things come together and position us well for further growth for the final quarter of 2021 and well into 2022. So that is the end of the presentation. I think we're at about 36 minutes in. We've got plenty of time for questions if anyone would like to ask some
Fantastic.
questions.
Hamish, thank you very much indeed for your presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the top right-hand corner of your screen. Just while the company take a few moments to review those questions, I'd like to remind you that recording of the presentation, along with the slide deck and the published Q&A, can be accessed via your investor dashboard. Christian, we received a number of questions, both pre-submitted, and obviously you can see those through today's live event as well. If I may hand over to you just to run through the Q&A session, if I could just ask you to read out the question where appropriate to do so, that'd be great.
Great, thanks very much, and thanks so much for that lovely update. So what I'm going to do is just focus on the most general questions first, and then there's a few more regarding specific companies that you hold. So for the first one is from Mark. Please, could you talk about the private equity team that manages the BPET portfolio, selects funds, diligence on co-investments, etc., the number of people, background, etc. Does the team manage other private equity vehicles too? Thank you.
Yes, we do. We've basically got about 9 other private equity vehicles that we manage. Each of them essentially does something that is a bit of a subset of what we do within private equity trust. So private equity trust essentially gets, all our good ideas are in private equity trust. It is different from the limited partnership funds because it's a permanent capital vehicle, so it doesn't have a sort of finite life in the way that some of the limited partnership the limited partnerships all have a finite life, usually 10 or 12 years. The team basically is organized. They each have geographical responsibilities, so they'll each have 2 or 3 countries that they're expected to be expert in, and we also divide it down functionally as well. So somebody will be looking at healthcare funds and companies, somebody else venture capital, and so on. But they all cover the UK, which is the home market. And they've all got strong academic qualifications and professional qualifications and a lot of experience. I think within the team, I think we've got something like 150 years or more of investment experience.
That's pretty impressive. Thanks very much. So then there's another question about your process. Is it problematic to retain a valuation discipline given the amount of dry powder in the sector? That's from Sean.
Yeah, I think probably what Sean's hinting at is that pricing has moved up because of this sort of level of activity. The weight of money going into private equity, and the money is going into private equity for very good reasons. They think they can make strong returns there. Pricing has gone up a bit. We are highly price sensitive, but to put it in context, if you look at co-investments where we are investing about half the portfolio directly into private companies, we see probably about 100 co-investment, good co-investment opportunities per annum, and we'll probably implement about 10% of that, maybe slightly more in a really busy year. So 90% is being rejected generally on the grounds of price, valuation, and hence projected return. We will not invest in a co-investment if we don't think we can make a net internal rate of return, an IRR of at least 25%, which is quite a high hurdle. So you're absolutely right. We do have to maintain that discipline. So most of the time we say no to people, but we're quite experienced at it. I've been saying no to people for well over 30 years. So we do it nicely, of course, but that's very important if you are to maintain your discipline. There are always opportunities to invest, even in when you might say the markets are very frothy. There will always be some opportunities to deploy capital. So it's very unlikely you would have a period where absolutely nothing happened. But obviously there are some periods where you're more active than others.
Great. And then continuing that theme, on the flip side, what triggers a disposal? Stephen asks, do you set a time or a value target when you first invest in a business?
Yeah, so when you invest in a business, there is always a section in the paper which talks about exit. When will the exit be? And indeed, who are we likely to sell it to? So there's an investment thesis, which is typically a sort of 4-year plan, sometimes 5-year plan. If it all goes really well, they might sell out after 3 years. A couple of the exits I talked about, we'd exited after 3 years. So it's all about having achieved the plan, made an adequate return, not trying to be too greedy about sort of hanging on for too long. We're believers in the adage that it's always right to take a profit. As I said, after three years or so, the lead managers, will discuss with us what the plans are for exit, and they'll start a sales process where they will appoint a firm of advisors who will then go out and see who might want to buy the business and how much they might be prepared to pay, and then that will be sort of whittled down to a small list who will conduct some kind of an auction to sell the business, and if the prices resulting are adequate, then we'll sell. So it's all about achieving plan. Sometimes if plan is not achieved, then it's about sort of cutting while you're still ahead, and that it's the same kind of parameters that are considered, except you may have to take a smaller return than you had originally planned for.
Hopefully that wasn't an important call that you just missed. There's a few people who have asked about the announcement that went out this morning on the RNS about the institution that's decided to exit. So if you could maybe shed a bit more light on that. People are asking, the prospects look positive. Why did they decide to sell? Is there a reason behind it, really?
Yeah, so it's nothing to do with the prospects of the company. It's basically one of our shareholders who is in the middle of a reorganization. And essentially they are swapping a portfolio of assets for an insurance policy. It's a pension fund essentially. So they've got no option but to sell. They've been holding off for as long as they possibly can. And the reason we've made the statement, it's a so-called cleansing statement, which the practice in the stock market now is if you've got something like this coming up, particularly when we're very close to the start of our close period, this is just a necessary thing that you have to do in order to try and to place these shares in an orderly fashion. So essentially, it's a great opportunity to get in at probably a lower price than you otherwise would be able to.
Yeah, and related to, say, trading and the share price, Simon asks, what do you see as the best mechanism to manage the discount to the NAV if it expands again?
Yeah, well, the best mechanism is a pretty straightforward one, which is to get the story about the company out there and to get genuine buyers of the shares. Now, the key target market for us is the sort of wealth manager tier. And also, various institutions, including pension funds, insurance companies, etc. So we operate in a competitive market. We've got to get our message across and get them to buy more shares. We've had some pretty loyal long-term investors. So that is by far the best way of narrowing the discount. We have got the power to buy back shares if the discount were to get sort of anomalously wide, and particularly if it was wide in relation to our peer group. And if everybody's discount is ballooning out, there's a limit to what buying back your own shares can do. But if we were standing out against our peers, we could buy back shares. It's a power that we routinely take, but we very, very rarely exercise it, because it does lead to a shrinkage in the overall size of the company, which does have, knock-on consequences if we were to do that repeatedly.
Yeah, fair point. Now, Michael asks, thank you for talking about some of the successes. Can you shed some light on some of the turkeys? Is his choice of words, if there are any?
Yeah, well, obviously there are some. I once was reviewing the track record of another private equity manager, and he claimed to have had no losses, when I was pretty suspicious about that, because he had been in the industry for over 20 years. And on further investigation, that turned out not to be 100% true. So obviously there are things that go wrong. I mean, what tends to happen is that they'll have a hit, they'll get written down, they'll either be refinanced and recover, or they'll have a further hit, and then the holding will become, nearly worthless, and it will not have that much. You'll have had the negative impact, if you like. And we've got one company I would not like to be quoted as describing it as a turkey, but one which has had certain difficulties as a result of the pandemic. It's a restaurant company in America called Rosa Mexicana, which has struggled because all the restaurants were shut during the pandemic, but it has recovered nicely, and we think we'll still make a decent return on that in due course. I mean, Weirdfish, which is our largest holding, that was actually looking quite concerning earlier in 2020, but as I said, it managed to make a great transition and recovered very strongly. So the key thing about private equity is making sure you don't have too many zeros in your track record, because that does mess things up if they go above a certain proportion. And so the best private equity managers will very much stick with a troubled company to see if they can at least recover some of their investment, if not make an actual profit.
Yeah, that makes sense. Robert asks, what is the average uplift on exit versus last value? And then also, what is the better sector to invest through, either co-investment or through funds?
Yeah. So the long-term typical uplift from the latest valuation to an exit is about 35%. In some periods, it can be quite a lot more than that, and obviously at individual level of an individual deal, it can be a lot more than that. It can be 50% or more, but the sort of long-term average would be around about 35%. You're simply reflecting that you're going from an illiquid holding to some form of liquid, either cash or securities or whatever. So first of all, that demonstrates that the valuation methodology of private equity is naturally conservative, because you do generally get that uplift. It's very rare for you not to get that uplift. So that was the first question. What was the second part of that question
It
again?
was what's the best route to go through, co-investments or funds?
Oh yeah. So well, basically they're both good routes to do, but there's a different risk profile. So co-investments, because you're going directly into individual companies, it's higher risk. If you're going through funds, you've got a much broader portfolio and therefore naturally lower risk. But there are, other aspects. Investing through funds, they're generally the fee drag for the fund tends to reduce your return a little bit. Whereas with co-investments, we quite often don't have fees at all, or we have smaller fees, and the fees are only on the invested capital, not the committed capital. So the economics, in other words, is a little bit better in co-investments, which improves the returns. In our experience, we have generally done better in co-investments than we have in funds by a few percentage points per annum. That doesn't mean that we would move entirely to doing co-investments. The balance we have at the moment, which is roughly half and half between funds and co-investments, we think provides a good position on the sort of risk-return spectrum, where you've got a very well diversified portfolio, both from the fund portfolio but also from the 30-odd co-investments. But at the level of the individual co-investments, the positions are significant enough that if they go well, they can move the needle quite positively. If they go badly wrong, it is not the end of the world. So we're quite happy with our sort of diversification and our balance between co-investments and funds at the moment.
Both Edward and Simon are asking about the Nav calculations and what explains the delay with the publication of the Navs.
Yeah, so basically we take the net asset value from the underlying funds and from the underlying investments. So the valuations are all compiled according to the International Private Equity Valuation Guidelines. So this isn't, you can't just press a button and the value of the company comes up. These are not listed companies. So these are essentially valuations that are based upon, backward looking profits, often looking at the multiples of equivalent companies in the stock market, applying a discount for size, illiquidity, that kind of thing. And then you come up with a number. But they have to calculate those numbers, then they have to report that to us, then we have to compile it all together, and we have to get our results out within the designated period, which is 3 months from the year end. So typically our results will come out in the last week of March, and it's actually quite difficult to get full coverage of, or nearly full coverage of, the portfolio if we were to produce our results much earlier than that. Obviously, we've got to get, our auditors have to then check our calculations and check the underlying calculations. So much as we would like to be able to produce the numbers, now on the 13th of January, it's just not possible. So that explains the delay. The quarterly numbers is a smaller delay. It's normally a couple of months after the quarter end.
Okay, perfect. Thanks. Roger is asking about gearing. He's firstly asking, did I hear you say that it is the ratio of debt to cash flow? Maybe just help define gearing. And then, is the debt bank debt, or does it include suppliers? And then cash flow is from operations, or is it after CapEx?
Yeah, so just to clarify, when I mentioned that, I was talking about the level of debt in the underlying companies in the portfolio. So what I meant was that the debt to the ratio of debt to the earnings before interest, tax, depreciation, and amortization was, I think, 2.6 times. So that is gives you an idea of the gearing in the underlying companies. That is almost always bank debt for those companies. Management buyouts almost always have debt in their capital structure. It's part of the means by which they can make returns. So gearing for the company as a whole, for the investment trust, as I said, we've got £12 million of debt at the moment, which works out at a very low level of gearing. It's about 3% or so. Gearing is low in the investment trust just now as a product of the very strong realizations that we've benefited from in 2021. We typically aim to have gearing up to sort of into the teens, mid-teens is probably quite an optimal situation to be under normal conditions. If gearing ever gets up to about 20%, that's normally temporary, and we would reduce it down again. Our gearing is provided by a bank, in our case, the Royal Bank of Scotland International, and it is structured with a term loan, which is essentially a sort of 4 or 5 year loan of 25 million euros, and then we have a revolving credit facility which we just use when we need it, over and above that, which is 95 million euros. So essentially, we draw down that borrowing when we need it and then repay it. It's a committed facility, so we do have to pay a non-utilization fee for it, but the terms are pretty competitive. So that is bank debt. The portfolio, as I've already described, is very well diversified, so it is a good portfolio against which to gear. You've got literally hundreds of underlying companies, so the banks are quite happy to lend to us as an investment trust, and they always have been. I mean, even in the depths of the global financial crisis, we still had a choice of borrowers, which was quite something considering the trouble the banks were in then. We historically have had a zero dividend preference share, which is essentially another form of debt, but we redeemed that after 5 years. It was quite an expensive way of borrowing money, and so we also aren't massively enthusiastic about having structural debt. So where you have debt which will naturally stick around for years on end, irrespective of what's going on. So a revolving credit facility is in our view a much more appropriate way of gearing the balance sheet.
Okay, thanks. I know we're running out of time. Maybe one or two more questions. Bruce is asking about costs. Maybe you could expand a bit about the trust costs. He specifically asked if there's lead manager costs and the cost of the funds that you've invested in.
Yeah, there is. Yeah, so basically there are layers of costs involved. I mean, private equity, as you probably gather, is quite labor intensive and expensive way of doing investment management, albeit it does deliver extremely good net returns. So, I think I would encourage everybody to focus on the net returns. But, there are our fees, so we have a basic fee and then we have a performance fee. So the basic fee is 90 basis points on the net assets, essentially. And then there's a performance fee, which depends on our returns being at least 8% per annum on a rolling 3-year basis. And if it is at that level, then we get 7.5% of the annualized gain. That is all subject to an overall cap. So the overall fee, that is the basic fee plus the performance fee, can't be more than 2%. We've never actually got up to the right up to the sort of cap. But we get close in a year like the one we're having. But so that's our fees. Then there are fees for the underlying funds and co-investments. So those vary, but the typical structure of a private equity fund is a sort of 2 and 20 structure with a 2% management fee based off commitments and a 20% carried interest, obviously subject to them achieving carried interest. And so and then for co-investments, the fees are lower, quite a bit lower. It might be 1% and 10% carry, or sometimes no fee at all. So, there are a couple of different, and then there are other expenses, etc. So when you look at a private equity investment trust and you compare it with a sort of plain vanilla listed equity trust, you are going to see, a higher total expense ratio, all things being equal. But there's a reason for that, because, the costs of paying for these investment teams and all that sort of thing has to be borne. But the net result is a lot better. So that's the thing that I would encourage people to focus on.
Christine, thank you very much indeed. We are just coming up to the time. Thank you so much for addressing so many of the investors' questions. Thanks to the investors for submitting them. I know that there's quite a few there. And of course, the company will get the opportunity to review all those questions submitted today, and we'll publish some responses where appropriate to do so. Before redirecting investors to provide you with some feedback, which I know is particularly important to you, could I just ask you just for a few closing comments, please, Hamish?
Yes, I think what you will have hopefully gathered from my presentation is that there is good momentum in this portfolio. I think there's plenty to go for. We've got some excellent investments. We're investing alongside some really talented and skillful partners. And so we expect the momentum that has been established throughout the pandemic to continue into this year and beyond. We have a very broad portfolio. It gives you exposure to lots of different types of company, different sectors, geographies, different management styles. And over the last 23 years, it has delivered a really strong return. And we see no reason why we shouldn't be able to continue to do that going forward. We have got excellent deal flow. We're well positioned in our marketplace, and we're going to take take advantage of that deal flow to continue to build good returns for shareholders into the future. I'd just like to thank everybody for their time and attention that they've given to the company. And obviously, if there are any other questions that you don't think we've dealt with properly, you can easily get in touch with us and we can pick up with you then. Thank you very much.
Hamish, Christine, thank you again for addressing so many questions. You've had a great amount come through, and for updating investors today with such a comprehensive presentation. Can I please ask investors not to close the session? It should be automatically redirected to provide your feedback in order the team can better understand your views and expectations. It will only take a few moments to complete and is greatly valued by the company. On behalf of the team at BMO Private Equity Trust PLC, we'd like to thank you for attending today's presentation. Thank you and good afternoon to you all.